Welcome to the deep dive. Today, we're ripping the cover off Chipotle Mexican Grill.
Yeah, we're digging into their Q3 fiscal 2025 results and, maybe more importantly, their whole strategy.
Exactly. How are they planning to get more people through the door or, ordering online when the economy is making things so tough for everyone?
It's a really critical moment for them because Q3, well, it showed both strength and some real vulnerability.
Okay, so give us the snapshot. What did the top line look like?
Top line looked, pretty decent. Total revenue was up 7.5% compared to last year. Hit $3 billion. Solid number.
I sense a but coming.
There's definitely a but. The key number, we always watch comparable restaurant sales, or comps, was almost flat, up only 0.3%, barely moved.
0.3%. And how did they even get that tiny increase? Was it more people?
No, that's the catch. It was entirely because the average check went up 1.1%.
Meaning people spent more per visit, maybe adding guac or a drink?
Exactly that. But the actual number of visits, the transactions, those were down 0.8% lower. Fewer visits.
Okay, so fewer people are coming, but they're spending a bit more when they do. That explains the flat comps.
Right. And that slowdown in traffic plus, costs going up, it squeezed their profits a bit too.
How did that look? The margins.
Restaurant level margin dipped, dropped 100 basis points from last year down to 24.5%.
Yeah.
Still healthy, but, a noticeable decline.
But one area held up really well, didn't it? Digital sales?
Oh, yeah, absolutely rock solid. Still accounted for 36.7% of all their food and drink revenue. That digital engine is crucial.
So the big question everyone on the earnings call probably had was, why are transactions down? What did management say?
Well, they were pretty direct about it, which was refreshing. They pointed squarely at persistent macroeconomic pressures.
So not blaming a failed LTO or, bad marketing.
Nope. Straight up said it's the economy. It's the pressure on consumers' wallets.
Okay, let's unpack that. Did they specify which consumers are feeling it the most?
They did. Very specific data. The biggest hit is coming from their low to middle income customers.
Define that for us.
Households earning less than $100,000 a year. That group makes up something like 40% of their total sales.
Wow, that's significant. And they're just dining out less everywhere.
Pretty much. Inflation worries, general economic uncertainty, they're cutting back.
And there was another group too, right? An age bracket that's facing particular headwinds.
Yeah, the 25 to 35-year-olds. Chipotle actually gets a lot of business from them, about 25% of sales.
And what's hitting that group?
It's kind of a perfect storm for them, isn't it? Student loan repayments restarting, maybe higher unemployment for that age group, wages not keeping up with inflation.
Ugh. Yeah, that makes sense. They're pulling back significantly then.
Meaningfully, yes. That's what the company said.
Now, here's something I found interesting. Usually when people cut back, they trade down, right? Maybe go from Chipotle to a cheaper fast food place.
You'd think so.
Yeah.
But the data actually shows Chipotle is gaining market share against their restaurant peers.
So they're not losing customers to quick service rivals.
Correct. They're losing them, and this is the key quote, to grocery and food at home.
Ah, okay. So people are choosing to just cook or eat leftovers instead of going out at all. It's a frequency issue, not a choosing a competitor issue.
Exactly. It's driven by economics, not because people suddenly don't like Chipotle anymore.
And this softness, it didn't just magically stop at the end of Q3, did it? What about October?
No, unfortunately. Management mentioned the underlying transaction trend actually got a bit weaker moving into October, followed step-downs they'd already seen in July and August.
Which forces them to adjust their outlook for the rest of the year, I assume.
It does, and it's a pretty tough reset. They now think full-year 2025 comps will actually decline in the low single-digit range.
A decline for the full year. Wow. And Q4 specifically.
Expected to be even tougher. Comps declining in the low to mid-single-digit range for the fourth quarter. It signals the pressure is building, not easing up yet.
Okay. A challenging picture. So let's pivot to their response. How are they fighting back without resorting to, deep discounts?
Well, that's the first thing. The CEO made it absolutely clear. Quote, "Value as a price point is not and will not be a Chipotle strategy."
No dollar menus coming soon, then?
Definitely not. They're refusing to play that game. Instead, they're focused on what they call their consumer flywheel.
Okay, what does that involve?
It's basically three things. One, get better at execution, making the food right and fast. Two, communicate their value better, remind people what they get for their money. And three, speed up innovation, new menu items, digital improvements.
And their argument is that they already offer good value, right? They just need to deliver it better and talk about it more.
Precisely. They point to data showing their prices are already like 20 to 30% lower than comparable fast casual competitors.
Hmm. And they also said their price increases have been more like grocery store inflation than restaurant inflation.
Yeah. They argued their pricing is tracked closer to food at home.
Yeah.
So their point is the value proposition is strong, maybe stronger than ever. They just need people to feel it.
And a big part of feeling it comes down to speed and consistency, especially during busy times, which leads to operations.
Right. Huge investments there. The big one is rolling out this high-efficiency equipment package. They call it HEAP.
HEAP. Okay, what is that exactly? Sounds serious.
It is. It's a multi-year system-wide upgrade, not just tweaking things. We're talking new hardware in the kitchens.
Like what kind of hardware?
Things designed for speed and consistency. A dual-sided grill or plancha that cooks chicken and steak way faster, less than half the time they claim.
Okay, that directly addresses a bottleneck. What else?
A bigger, better 3-pan rice cooker and a high-capacity fryer. It's all about getting food out faster and more consistently, especially during those peak lunch and dinner rushes.
And they've tested this. What were the results in the pilot stores?
They reported real benefits. Better labor efficiency, staff can do more consistent food quality, and just smoother operations when it gets crazy busy. That new grill, for instance, frees up time and space.
Makes sense. Better throughput. But it's not just about fancy new equipment, is it? They also admitted some basic blocking and tackling issues.
Yeah, they did their own problem detection survey and found issues with things like digital order accuracy, getting the online orders right.
The missing kids quesadilla problem the CEO mentioned.
Exactly that. Also, sometimes running out of ingredients or dining rooms not being clean enough. Basic stuff that really annoys customers.
So how are they fixing that? More training?
System-wide retraining, yes, but also, crucially, they're changing the bonus structure for managers.
Tying bonuses too.
Directly to things like digital order accuracy and guest experience scores. Put the money where the problems are. That should get attention.
Okay, so fix the foundation with HAP and better execution. Then what? How do they actively drive people back in? Menu innovation.
That's a huge lever for them. And they shared a fascinating insight. Apparently, over 90% of Gen Z consumers say they're drawn in by new sauces.
90% just for sauces. Wow.
Yeah. So things like the adobo ranch dip they had,
Yeah.
that brought in new people. And the red chimichurri sauce with the recent carne asada LTO, that got people trying the steak, saw really good uptake, low double-digit incidence, as they call it.
So expect more new flavors.
Definitely. The plan for 2026 is to seriously accelerate innovation. They used to do maybe 2 limited time offer proteins a year. Now they're aiming for 3 or 4.
Plus more sauces, dips, sides. Keep things fresh.
Exactly. Keep giving people a reason to come back, create some buzz, increase how often people visit.
They're also looking beyond the standard lunch and dinner visit, right? Trying to capture new occasions.
Yeah, areas where they're honestly way behind their peers, like catering.
Right. They said catering is only like 1 or 2% of their sales.
Tiny. While competitors might be at 5, even 10%. So there's a big opportunity there.
And they're piloting something.
Yep, a 60-restaurant catering pilot in Chicago. Using that new HEAP equipment and some new tech to handle bigger orders without messing up the main line.
Makes sense. And what about smaller groups? Not quite catering, but more than one person.
They launched something called Build Your Own Chipotle for groups of 4 to 6 people.
Because big groups don't really go to Chipotle much now.
Apparently not. Groups of 4 or more are only like 2% of transactions. So tapping into that small party family meal market could be big. Early feedback is good, they say, and it's not stealing sales from individual orders.
Okay, and the digital side, beyond just ordering, loyalty programs.
Huge focus there. Driving engagement through their rewards program, they found that gamification works really well.
Like those contests they run, Summer of Extras, Chipotle IQ.
Exactly, free Poli. Those things measurably boosted sales among loyalty members compared to regular customers.
And they have that college program too, Chipotle U.
Yeah, also seeing success there, getting students enrolled and spending more. And they teased significant additions coming to the rewards program next year. It's all about making it sticky, making people feel rewarded for coming back often.
Okay, this all sounds like a solid plan, but there's always a cost, right?
Right.
What about the financial side, the trade-offs? Inflation isn't going away.
No, it isn't. And the CFO is pretty blunt about it. They expect inflation to accelerate again, mid-single-digit range, mainly due to tariffs and rising beef costs. That's a headwind.
So costs are going up. But you said earlier they're not planning aggressive price hikes to offset it immediately.
That's the crucial decision. They've decided not to fully pass on those costs right away, which means, yes, margins are going to get squeezed in the near term.
Why do that? Why take the margin hit?
To protect that value perception, they keep talking about that 20–30% price gap to competitors. They believe maintaining that gap now is more important for driving traffic than protecting short-term margins.
So pricing strategy is changing. No more big, once-a-year increases.
Correct. They're moving away from that. Instead, it'll be a slow and measured approach to price increases spread throughout OT26.
Which will cause some short-term pain on the profit line.
The CFO called it a temporary dislocation in margins. But importantly, he reaffirmed their long-term goals are still intact. High 20s restaurant margin, 40% flow-through. It'll just take a bit longer to get back there.
It's a gamble then, betting that keeping prices relatively lower now will pay off with more customer visits later, letting them eventually raise prices once the economy improves.
That seems to be the strategy. Prioritize traffic and value now, earn the right to expand margins later.
Okay, despite all this near-term pressure on traffic and margins, what about growth? Are they tapping the brakes on opening new restaurants?
Not at all. If anything, they're hitting the accelerator. It shows real long-term confidence.
How aggressive are we talking?
For 2026, they're targeting 350 to 370 new restaurants. That's up from the 315 to 345 planned for this year.
Wow. And still focusing on Chipotlanes.
Oh yeah, over 80% of the new builds will have a Chipotle drive-through. Convenience is key. And they still feel confident about eventually reaching 7,000 restaurants just in North America.
So domestic growth is strong. What about international?
Also accelerating. They're planning more company-owned openings in Europe next year.
And the Middle East partnership.
That's growing too. They just opened their first one in Kuwait, bringing the total there to 7 partner restaurants. And apparently, the opening sales volumes in the Middle East have been incredible.
As good as the US and Canada.
That's what they said. Rival the best we have seen. Plus, big news for Asia.
What's happening there?
First joint venture announced. They're partnering with a company called SPC to open restaurants in South Korea and Singapore starting in 2026.
South Korea first. Interesting choice.
They specifically mentioned South Korea's influence as a global trendsetter in pop culture. Seems strategic.
Okay, so wrapping this all up. Chipotle's facing undeniable headwinds from a squeezed consumer. Transactions are down, margins are pressured.
Right. But instead of panicking with discounts, they're doubling down on their core recipe for growth. Investing heavily in making the restaurants run better, that HEAP rollout is key.
And innovating faster on the menu, trying to capture new occasions like catering and making their digital loyalty program stickier.
Exactly. All while deliberately holding back on price increases to maintain that value gap, even if it hurts margins for a bit.
The long-term goal remains ambitious. Get back to solid mid-single-digit comp growth, hit $4 million average sales per restaurant, and become a truly global brand.
It's a strategy built on operational strength and brand value, trying to ride out the economic storm.
Which brings us to a final thought for you, the listener, to chew on. Chipotle's betting big that improving operations and rolling out new menu items will bring people back, even while they lag on price hikes.
But what if the economy for that crucial under $100 K household, that core group, doesn't get better in 2026 like many economists hope? If that pressure persists and they've sworn off deep discounts, what other levers could they realistically pull?
What non-price tool could re-engage those customers without potentially delaying that margin recovery even further? Something to think about.
Definitely a high-stakes balancing act for them.
Indeed. That's our deep dive for today. Thanks for joining us.